in that business. Now, how much that money costs to the businessman, you see, that we are going to study in this particular block. Cost of capital, this is unit 5. Every business requires funds to operate, and these funds come from different sources. You see, some people invest money in the business, owners also invest money, and some people are investing for the sake of earning, you see, dividend, interest. So money comes from different sources such as personal savings, loans. You see, the businessman borrows from the banks, he borrows from financial institutions, banks, loans or financial institutions. Whenever money is invested in a business, whether it's by the owner or board, you see, there is a cost involved. You see, even if the business owner invests his own money, they are going to return that money, you see, to the businessman. Now, that is why in the balance sheet you will see that on the liability side there is capital. You see, capital introduced by the, you see, proprietor, if it is a proprietorship concern. And on the asset side, you see how they have, you see, spent the money for buying raw material, for buying fixed assets, for buying any shop, land, building, etc. And on the liability side will be, you see, owner's stake. You see, the person who is owning the business, how much did he invest, that is his capital. Then bank borrowings from the financial institutions, and if they have issued shares, you see, borrowed money from the public share capital, that you see, application money, allotment money, then first call, second call, you see. Like this, you see, businesses, they collect money and then they start the business. Suppose Reliance comes out with any, you see, company, new company, so it will promote shares, say 10 rupees share, available at a premium of 20 rupees or 30 rupees premium, and those 10 rupees, you see, they say that 2 rupees is, you see, application money, then 3 rupees allotment money, then 3 rupees is first call, 2 rupees is final call. The 10 rupees they divide like this, you see, and people, whosoever wants to buy the shares, they will fill the application, enclose the check of application money and submit it in the bank, you see, and company is collecting money like this, and then they, you see, buy raw materials and they spend in other things for production which are required for production. So every business requires funds. Without funds, you see, one cannot proceed, one cannot start the business. Every business requires funds to create, to operate, and these funds come from, you see, different sources. For operations, funds are required and they come from different sources. Personal savings of the owners, then loans or money from financial institutions. Whenever money is invested into a business, you see, whether it's by owner or, you see, borrowed, there is a cost involved. You see, suppose you have borrowed the money from the bank, they will take interest. You have to return the principal as well as the interest, or periodically you have to service the interest. Even if the business owner invests his own money, they are going to return That is why we just now saw that in the balance sheet, you see, on the liability side of the balance sheet there is capital. Business and businessman, they both are, you see, different. This foregone return is called, you see, cost of capital. How much that capital is costing to the business. In simple words, it is the minimum return that a business must generate from its investment to justify the use of these funds. All major financial decisions are made after taking the cost of capital into consideration. Whatever is the cost, that much amount the business should earn, you see, to survive. If business will not earn that much amount, then they will have to close down the business, because that is not profitable, that is not remunerative. So this foregone return is called cost of capital. In simple terms, it is the minimum return that a business must generate, from its investment to justify the use of those funds. All major financial decisions are made after taking the cost of capital into consideration. Cost of capital refers to the minimum rate of return that a business must earn on its investment to maintain its market value. It is not about the total amount but a percentage or rate. It represents the return that the company must offer to those who have invested money in this, whether shareholders or lenders. It plays a critical role in investment decisions because it is used as a benchmark for comparing the expected return from a project. If a project earns more than the cost of capital, it adds value to the company. If not, it could reduce the firm's value. Now, what are the components of cost of capital? The cost of capital is made up of three key parts. First is return at zero risk. This is the return expected from a risk-free investment like government bonds or a savings account. Banks FD will give 10% interest, 9%, 8%. Comparatively, it is less, but your principal is intact. Your principal will never reduce. Like if you invest 1 lakh rupees in a bank, you invest 1 lakh rupees in share market. Tomorrow the value of shares may become 1,20,000 or it may become 90,000. Whereas your investment in the bank, in the post office, in the government bonds, the principal amount will never reduce. Plus, principal plus interest, whatever is the rate they will give you. So, number one is return at zero risk. The investments where those investments are, very, safe investments where your principal will never, reduce, like investing money in bank, investing money in post office, investing money in government securities. Second is business risk premium. Now, extra return expected because running a business involves uncertainty and operational risks. Third point is financial risk premium, additional return needed due to the use of borrowed money, which brings repayment obligations like interest. If earnings are not there, then how the company will pay the interest? Suppose the company has borrowed, the company is having a cash credit limit of 1 crore rupees with a bank. Cash credit limit means when company wants to buy the raw material, they will take out the money from the bank, bring raw material, pay rent of the factory, pay electricity bill, pay salary to the workers. All these things are done from by that account where the limit of the company is 1 crore rupees. And after that they will start the production, and then goods are finished goods are there, they are sold in the market, then company receives the payment. So this is one cycle starting from money, and in the end money is, you see, money comes by sale proceeds. So money, then you will buy raw material, then production, then finished goods, then sales, then money. Again, you see, sales will realize, you see. Third is, you see, financial risk premium, additional return needed due to the use of borrowed money, you see, which brings repayment obligations like interest. Just now we discussed. Now, what are the components of cost of capital? The overall cost of capital, you see, increases if the business is risky, or if the company has a high level of debt, you see. Now, debt equity ratio, you see, debt equity ratio means whatever is the borrowed money and whatever is company's own stake. If that ratio is very high, you see, then you see cost of capital will increase. Next is, you see, business risk arises from factors like changing consumer preferences, you see, then pandemics or economic shifts, you see. Now, many times consumer will, you see, change his, you see, choice. Some other, the customer will go for some other product. Then pandemics like corona comes, you see. Then there are, you see, economic, you see, boom, economic shifts are there. Third point is there financial risk. Financial risk comes from having too much debt, you see. See, if you have borrowed, you see, more than what is required, that is also not good for the business, you see. So financial risk comes from having too much, you see, debt, which creates pressure to make regular payments regardless of, you see, business performance. If the performance of the business is not good, even then you have to make regular payments. From where the business will bring money, you see. All these things, you see, the business has to see. Types or classification of cost of capital. Now, explicit cost and implicit cost. There are two types of cost: explicit cost and implicit cost. Explicit cost is the clear direct cost paid to raise funds, like interest on loans. You see, that is the direct cost. That is the, you see, clear and direct cost. Implicit cost is the opportunity cost of not using the funds, you see, elsewhere. So implicit cost is the opportunity cost of not using the funds, you see, elsewhere. Next is average and marginal cost. Average cost is the weighted average of all the different sources of capital. And marginal cost is the cost of raising additional funds for a new project. You see, the difference is clear here. Average cost is the weighted average of all the different sources of capital. And marginal cost is the cost of raising, you see, additional funds for a new, you see, project. Then historical and future cost. Historical cost is based on funds, you see, raised in the past. You see, what was the cost in the past when the funds were raised? And future is cost, what it will cost to raise, you see, new funds. So future cost is what it will cost to raise new funds. Next is specific and combined, you see, cost. Specific cost refers to the cost of each source individually, like cost of debt, cost of equity. Next is combined cost is the overall cost of capital using all the sources. You see, if we go for combined cost, that is the cost of all the, you see, cost of capital using all the sources. From where the money has come, you see, cost of all those. Next is, you see, opportunity cost. This refers to the return you give up by, you see, choosing one investment over another. What is opportunity cost? This refers to the return you give up, you see, by choosing one investment, you see, over the another. Significance of cost of capital. It helps evaluating whether a project is worth investing in it, whether the project is technically viable, economically feasible. You see, it helps in evaluating whether a project is worth, you see, investing in. It acts as a, you see, hurdle rate. If a project can't earn more than this, it is not, you see, worthwhile. It helps determine the right mix of debt and equity in a company's, you see, capital structure. How much is going to be the equity and how much is going to the capital equity, and how much is going to the debt. Next point is, it is used to evaluate the performance of top management. It influences dividend policy and working capital decisions. You see. Next point is, it is used to assess the value or capitalization of a new business. What is the value of new business? Cost of capital helps to ascertain that. Cost of long-term debt. Long-term debt includes loans, you see, debentures and bonds. The cost of debt is the return that lenders expect after considering the benefit of tax savings, because interest paid on a debt is, you see, tax deductible. If the debt is issued at face value, the cost is simply the interest rate adjusted for tax. If issued at a discount or premium, or if there are, you see, issuance costs, then those adjustments are also considered, you see. Redeemable debts and bonds, you see, require more detailed calculations, even using the concept of, you see, yield to, you see, maturity. Now, next is cost of preference, you see, capital, equity capital, preference capital. Preference shareholders, the money collected by selling preference shares, preferential shares. Preference shareholders are paid fixed dividends. Their dividend is fixed. In the beginning only they are told that 5%, 6%. Preference shareholders are paid fixed dividends before equity shareholders. First preference shareholders are paid dividend, then equity shareholders are paid. The cost of preference capital is the expected return by, you see, preference shareholders. This is calculated by dividing the annual dividend by the amount the company actually receives after accounting for any issuance costs. If the preference shares are redeemable after a few years, then both dividends and the redemption, you see, amount are considered to determine the total cost. Now, cost of different sources of capital. Cost of equity capital. Equity shareholders expect a return on their investment in the form of, you see, dividends and capital appreciation. You see, one, they will get dividend every year, then their, you see, investment keeps on increasing, the value of share, you see, rises. Unlike debt or preference capital, this cost is not fixed. It is estimated based on different, you see, methods. First method is earnings, you see, per share method, EPS method, based on what the company, you see, earns per share and its, you see, current market price. Dividend yield method, based on dividends paid relative to the market, you see, price. Now, cost of equity capital, different methods are dividend growth method, includes both dividend yield and expected growth in dividends. Realized yield methods based on the actual returns received by investors in the past. Capital asset pricing model CAPM. CAPM capital asset pricing model considers the risk free rate, the market return, and the company's risk level, that is beta. Now, cost of retained earnings. Retained earnings are the profits that a company keeps instead of distributing dividends. Some portion of the profit is retained and remaining is invested in the business also. So retained earnings are the profits that a company keeps instead of distributing as dividends. Though companies don't pay for this money, it still has a cost. The return shareholders lose by not receiving dividends, hence it is considered an opportunity cost. The cost of retained earnings is usually estimated in a similar way to the cost of equity, adjusted for taxes and brokerage costs that shareholders would incur if they invested elsewhere. Weighted average cost of capital, WACC. The weighted average cost of capital is the average rate the company must pay across all its sources of capital: debt, equity, preference shares, and retained earnings. It is weighted by how much each source contribute to the total capital. This involves a more accurate picture of the overall cost of financing a business. The weighted average cost of capital is important because it is used to discount future cash flows when evaluating investment opportunities. A project must earn more than the weighted average cost of capital to be considered profitable. Now next is weighted average cost of capital, WACC. Choice of weights: book value weights based on values recorded in company books, market value weights based on current market price preferred for accuracy. Third is target weight based on the firm's desired capital structure. Fourth is marginal weight used when raising new capital. Misconceptions about cost of capital: some think it is just an academic concept, but it has real world application. Many wrongly believe it is the same as dividend rate. Third is retained earnings are not free, they have an opportunity cost. Depreciation does not provide free funds. It's incorrect to calculate cost of capital purely from accounting figures. Using a lot of debt does not automatically lower the cost of capital. High debt increases financial risk. Cost of capital is the minimum return a company must earn to meet expectations of its investors and lenders. It varies by source: debt adjusted for tax, preference capital, fixed dividend, equity, variable return, and retained earnings, opportunity cost. Knowing the cost of each source helps in calculating the weighted average cost of capital, which is used to evaluate projects and strategic decisions. There are various methods to calculate the cost of equity, each with its assumptions and limitations. Overall, the concept is critical for planning, investing, and maximizing shareholder value. Now we come on the unit 6, that is investment appraisal methods. Investment appraisal methods, referred to as capital budgeting decisions, are crucial in financial management because they involve the allocation of large sums of money, capital, for long term assets. These decisions are not isolated events, they are filed, they are tied to the firm's strategic goals such as expansion, modernization or diversification. Investment appraisal ensures that limited resources are allocated to projects offering the best economic returns. Since capital investment typically involves substantial costs and benefits spread over many years, it's vital to evaluate and compare project proposals through systematic appraisal techniques. This process is essential due to the size, risk and long-term impact of these decisions. Now, need for investment decisions. Investment decisions help organizations achieve long-term goals like growth, market expansion, leadership or survival in competitive markets. For example, a company may invest to increase production capacity to meet rising demand, to adopt new technology for cost efficiency, or to decide whether to buy, rent or lease assets. Each of these goals involves committing funds today for uncertainty for uncertain but potentially valuable returns in the future. Sound investment decisions are required to ensure that every rupee invested yields optimal results over time. Factors affecting investment decisions are capital outlay and future earnings. Management must carefully estimate the costs involved in initiating and operating a project and forecast the expected revenues. These costs include land, equipment, installation, training and initial working capital, current assets minus current liabilities. How much money is required for buying raw material, labor payment, daily expenses, that is working capital. Operating costs such as labor, maintenance, taxes and energy must also be accounted. Sources of capital. Capital can be internal retained earnings, depreciation reserves, or external. External means loans, equity. External capital may be short term used for working capital or long term used for fixed assets. Selection criteria. The firm needs appropriate financial criteria to select the most profitable projects and reject those with low returns or higher risks. Types of investment proposals. Investment proposals usually require long-term resource commitments often over 10 years. These proposals may be made for expansion to increase production, capacity, diversification to enter into new product lines or sectors, replacement or modernization to replace outdated machinery or adopt more efficient technology, research and development to improve the efficiency or create innovation. The investment appraisal process. The appraisal process helps evaluate whether an investment is financially sound. Before evaluation, consider initial investment, all upfront costs including the installation, design and working capital. Then subsequent outlays, cost for maintenance, replacements or upgrades. Then economic life, the period over which the product will generate useful returns. Then salvage value, estimated value at the end of the product's life. Then cash inflows, sales revenue, cost savings or other benefits over the project's life. Now, investment appraisal methods. Investment appraisal methods help assess a project's financial worth and provide a basis for, you see, comparing multiple proposals. A good method should help, you see, rank projects by desirability, differentiate acceptable and unacceptable projects, recognize the time value of money, consider the timing and pattern of cash flows. Appraisal methods fall into two main categories, you see, traditional and discounted cash flow. Now next is traditional methods, you see, first method is payback, you see, period method. This method calculates how long it will take to recover the initial investment from net cash inflows. A shorter payback, you see, period is considered better as it means quicker recovery of funds. However, this method ignores cash flows, you see, after payback period and does not, you see, consider the time value of money. It focuses more on liquidity than on profitability and thus is not a reliable standalone method, you see, for investment decisions. Next is, you see, accounting rate of return. In short, we write it as ARR. Accounting rate of return measures the average annual profit after taxes and depreciation as a percentage of the initial or average investment. It uses accounting profits instead of cash flows and ignores the time value of, you see, money. Moreover, accounting rate of return can influence by subjective accounting practices, making it, you see, less objective and reliable. Second method is, you see, discounted cash flow methods, you see, net present value method. Net present value is the difference between the present value of future cash inflows and the present value of investment outflows. If net present value is positive, the project adds value to the firm. Net present value is considered one of the most reliable techniques because it measures actual, you see, profitability over the project's life and aligns with the goal of maximizing, you see, shareholders' wealth. However, selecting the appropriate discount rate is critical and, you see, sometimes challenging. Internal rate of return, IRR, is the discount rate at which the present value of cash inflows equals the, you see, investment outlay. In other words, the break-even rate. If internal rate of return exceeds the required rate of return, the project is, you see, acceptable. Internal rate of return is intuitive because it gives results in percentage form, but it has, you see, limitations such as multiple internal rate of returns for non-conventional cash flows and complex, you see, calculations involving trial and error or interpolation. Next is profitability index, PI. Profitability index is the rate of the present value of inflows to the present value of, you see, outflows. A profitability index greater than 1 indicates a profitable project, while PI gives a relative, you see, measure. It may not always lead to the correct, you see, choice in mutually exclusive projects. In such cases, NPV is, you see, preferred as it directly measures, you see, value addition. Depreciation, tax and inflows. While depreciation is a non-cash expense and not directly, you see, included in DCF calculations, it impacts, you see, cash inflows indirectly by providing a tax, you see, shield. Since depreciation reduces taxable income, it lowers, you see, tax payment and increase cash flows. Thus, although not counted as a cash, you see, outflow, depreciation's impact must be considered while estimating, you see, after tax cash, you see, flows. Limitations of appraisal, you see, techniques. Despite, you see, being based on quantitative analysis, appraisal methods have some inherent limitations, estimates and assumptions. Future cash flows, you see, project like and residual values are often based on assumptions which may not be, you see, accurate. Inflation, ignoring inflation can distort, you see, estimates. Uncertainty, future sales, cost savings and other benefits are, you see, unpredictable. Subjectivity, you see, accounting methods or management bias can affect the, you see, results. Now, investment appraisal is key to long-term strategic, you see, planning and wealth creation. Capital budgeting decisions involve high stakes and long-term commitment, so they must be, you see, evaluated carefully. Traditional methods like payback and ARR are simple but, you see, flawed because they ignore the time value of, you see, money. Discounted cash flow methods, you see, NPV, IRR and PI are more accurate as they consider both timing, you see, and risk. Among these, NPV is generally considered the most consistent with the goal of maximizing shareholder wealth. However, all, you see, methods depend on accurate data and reliable assumptions, and no technique is, you see, perfect. Hence, financial, you see, judgment is, you see, just as important as, you see, technical accuracy. Now we come on the unit 7, that is management of working capital. How to manage working capital. Working capital is current assets minus current liabilities, you see. How much, you see, money is required to run the business. Say, for example, for payment to the labor, for payment of rent, factory premises, then electricity bill, water bill, then buying raw material. You see, we start with cash, we buy, you see, raw material, then production starts, semi-finished goods, finished goods, then those goods are sold, then, you see, money is realized. This is one, you see, cycle, starting from money and ending with money. So, now management of working capital. Working capital refers to the funds a business needs to carry out its, you see, daily operations smoothly. While long-term capital is invested in assets like buildings, machinery and, you see, expansion, short-term capital for or working capital is essential for purchasing raw materials, paying, you see, wages, maintaining inventory and handling, you see, routine business activities. So, this is a brief introduction about, you see, working capital. Now, banks, you see, they sanction working capital limits to the customers by seeing sales. If suppose, you see, your sales were, you see, 1 crore last year, bank can give you 20 lakhs, you see, cash credit limit against hypothesis stocks, hypothesis book debts, by seeing your sales, by seeing your performance. 20% of the sales that can be, you see, given. Now with this you will buy raw material, you will pay factory rent, you will pay, you see, water charges, electricity charges, all these, and raw material you will buy, you see, and production will be started, you see. Now, you see, working capital refers to the funds a business needs to carry out its daily operations smoothly, while long-term capital is invested in assets like, you see, buildings, machinery and expansion. Short-term capital or working capital is essential for purchasing raw materials, paying, you see, wages, maintaining inventory and handling, you see, routine business, you see, activities. These short term, you see, needs may not always result in immediate revenue, as goods may be held in stock or sold on credit. Hence, funds are tied up in a, you see, inventory and receivables. The role of working capital is vital in ensuring the uninterrupted, you see, functioning of business operations, and it's, you see, important and is as important as managing long term, you see, capital investments. Significance of working capital. Working capital is the livelihood of any business. No enterprise can function effectively without sufficient, you see, working capital. Even a company and with advanced, you see, machinery and a strong customer base will, you see, collapse without adequate cash to buy, you see, potential to buy materials, pay salaries, and manage day-to-day operations. Working capital ensures the business can manage, you see, delays in sales, extend credit to, you see, customers, and still meet its short-term financial obligations. It enables the business to remain, you see, operational, competitive, and, you see, financially solvent. Now, what do you mean by operating cycle? In short, one operating cycle means we start business with cash, we buy raw material, then we make, you see, semi-finished goods, finished goods, and then, you see, we start selling them. Now, finished goods, you see, many times in now these eatables, you see, people are not cooking food at home, they are eating, you see, outside. So, one operating cycle is starting from cash, buying raw material, paying salary, paying wages, you see, paying then rent, and then, you see, start production with the raw material, and then semi-finished goods are there, then finished goods are there, finished goods are, you see, sold, and, you see, payment is realized. So, the moment the payment is realized, so circle completes. So, this is the operating cycle, you see. The operating cycle or working capital cycle is the time between acquiring raw material and collecting cash from sales, you see. It includes, you see, stages like purchasing raw material, converting them into, you see, finished goods, selling them, and finally collecting payments. The longer the operating cycle, the more working capital is, you see, needed. The shorter cycle is more efficient as it ties up, you see, funds for a shorter, you see, duration, allowing better liquidity and faster, you see, recycling of resources. Concepts of working capital. There are two main concepts of working capital. One is gross working capital, then next is net working capital. Gross working capital, this refers to the, you see, total investment in current assets such as, you see, cash, receivable, inventory, and short term, you see, securities. It focuses on the size and composition of these, you see, assets. Then net working capital, this is the difference between current assets and current, you see, liabilities. It represents the liquidity better available to meet, you see, short term obligations. A positive net working, you see, capital means the company has more, you see, current assets than liabilities, which is desirable. A negative value is, you see, suggests potential, you see, liquidity issues. There will be issues, liquidity issues. Next is kinds of working capital. Working capital generally classified into two, you see, types. Fixed permanent working capital. This is the minimum level of current assets that a company needs to function, you see, continuously. Regardless of production levels, it remains, you see, invested in the business at all times and is, you see, comparable to long-term assets in terms of performance. Next is, you see, fluctuating working capital. This varies with the value of, you see, production, seasonal demand or special situations like marketing campaigns or emergencies. It rises and falls depending on business cycle and short term, you see, needs. Components of working capital. Working capital has two components: current assets, current liabilities. Current assets, these include cash, receivables, inventory, raw material, work in progress and finished goods, short term advances and temporary investment that can quickly be, you see, converted into cash. Current liabilities, these are obligations due within a short, you see, period, including credit purchases, unpaid, you see, expenses, short term loans, customer advances, you see, taxes payable and other, you see, dues. Key current assets, you see, cash, essential for running operations, making payments and seizing investment, you see, opportunities. Holding too much idle cash, however, is unproductive and, you see, costly. Yeah, if it is not useful, you can deposit with currency chest. You can deposit with your main branch after taking the permission. Next is accounts receivable, bills receivable, result from credit sales. While they, you see, boost sales, delayed collections tie up funds and may result in, you see, bad debts. So we have studied, you see, cash and account receivables. You see, cash essential for running, you see, operations, making payments and seizing investment opportunities. Holding too much idle cash, however, is unproductive and costly. Accounts receivable, bills receivable result from credit sales. You see, when goods are sold on credit, bill is raised on them. While they boost, you see, sales, delayed collections tie up, you see, funds and may result in bad, you see, debts. Efficient credit and collection policies are, you see, critical. The next is inventory, includes raw materials, semi-finished goods and finished products. While necessary for production and sales, excessive inventory leads to storage costs and, you see, potential losses. You see, you have to pay the rent of the godown if taken additionally godown is taken. Marketable securities, extra cash can be invested in short term low risk assets to earn returns while, you see, maintaining liquidity. So this is about, you see, where to, you see, invest. Next is, you see, importance of working capital management. Efficient working capital management ensures smooth operations and financial health. Management of working capital is one of the main reasons behind business failures. Too little working capital may return. If the money is not there, then you won't, you see, do production. Too little working capital may result in inability to pay bills or salaries, poor utilization of fixed assets, missed opportunities due to lack of funds, damage to the firm's, you see, credit reputation. Importance of working capital management, you see, on the other hand, too much working capital may lead to unnecessary inventory and storage costs, lax credit policies, you see, leading to bad debts, you see, management inefficiency and, you see, complacency, hence maintaining the right level of working capital is, you see, essential for balancing liquidity and profitability. You should not have more working capital, you should not have less working capital, you should have, you see, whatever is required, you should have that much, because you have to buy raw materials and then you will start production. Determinants of working capital, the amount of working capital a company needs depends on several factors. One is nature of business. Trading and service firms need more working capital than utilities which rely on fixed assets and you see cash sales. Business size, you see, larger operations usually require more working capital. Manufacturing cycle, longer production cycle require more funds uh, tied up in inventory and you see processing. Determinants of working capital, you see, business fluctuations, seasonal or cyclical changes impact inventory and receivables, hence altering working capital needs. Production, you see, policies, uniform production throughout the year may lead to inventory built up during all off seasons. Turnover of capital, you see, faster cycles reduce the need for capital. Then credit terms, liberal credit to customers increases, you see, receivables. Favorable credit from suppliers reduces, you see, capital needs. Now, determinants of working capital, further growth plans, expanding business and additional working capital, operational efficiency, efficient operations reduce waste, cost and capital needs. Price level changes, inflation increases the value of, you see, current assets, increasing working capital needs. Other factors, profit margins, dividend policies, logistics and taxation can also affect, you see, working capital. Approaches to managing working capital, there are two key approaches. One is conventional approach, focuses on individually managing components like inventory, receivables and you see payables to maintain balance and minimize cost. Operating, you see, cost approach, you see, calculates working capital needs based on the length of business cycle, that is from raw materials to cash, that is a business cycle. This approach is, you see, increasingly preferred especially by banks for, you see, lending decisions. Measuring working capital, to estimate working capital needs, business must, you see, consider costs at each stage of operating cycle, raw material, processing, finished goods, receivables and liabilities. A practical method involves estimating monthly production and costs, assessing holding needs for raw material, goods in progress, finished goods and receivables, subtracting liabilities like supplier credit or payment, you see, locks. Working capital management under inflation. Inflation increases the cost of assets and operations, thus raising working capital needs. Strategies, you see, manage this include, you see, using substitute raw material where possible, increasing, you see, labor productivity through motivation, avoiding unnecessary fixed costs like, you see, fancy office or redundant, you see, advertising. Speeding up the operating cycle by reducing delays, you see, timely payments to creditors to build goodwill and get better, you see, terms. Efficiency ratio, a company's profitability and stability depend on how well it manages working capital. Some signs of efficiency include, you see, ability to meet short-term obligations on time, maintaining high inventory turnover, managing receivables and payables within reasonable limit, avoiding both under trading and over trading. Next is several ratios help in assessing efficiency, such as current ratio shows if the company can cover its, you see, short-term liabilities. Quick ratio indicates short-term liquidity even without relying on inventory. Cash to current assets reveal how much of current assets are, you see, tied up in cash. Sales to cash, you see, ratio measures how often cash is, you see, used to generate, you see, sales. Efficiency ratio, several ratios help in, you see, assessing efficiency, such as average collection period, average payment period, inventory turnover, working capital to sales, working capital to the net worth. So average collection period shows how long customer takes to pay. Average payment, you see, period shows how long the company takes to pay its suppliers. Inventory, you see, turnover indicates how frequently inventory is needed. Working capital to sales, you see, assess adequacy of working capital. For the level of, you see, sales, working capital to net worth evaluates if capital employed is balanced with the, you see, owner's equity. Determining the optimal, you see, cash balance. Too much cash is unproductive, too little causes, you see, liquidity issues. You should always have money, you see. To find the right amount of cash, estimate maximum, minimum and average needs, factor in opportunity cost, returns lost by holding, you see, cash, maintain a minimum balance to meet obligations and retain creditworthiness, consider reasonable fluctuations and uncertainty in cost, you see, in cash flows. Management of cash flows, effective cash, you see, flow management includes speeding up collection, centralized collections, use banking technology like NEFT, RTGS, and avoid physical check to speed up, you see, fund transfer. Recovering dues, follow up, you see, regularly, offer early payment, you see, discounts and reduce overdue receivables. Management of cash flows, you see, controlling disbursements, delay payments up to, you see, due dates and avoid issuing checks too early. Investing the cash surplus funds, you see, should be invested in short term liquid and safe investment like treasury bills, mutual funds or deposits. Investment criteria, the investment should be, you see, secure, easily redeemable and yield some return. Liquidity, safety and profitability must all be borrowed. Working capital is essential for managing daily business operations. It is made up of current assets and current liabilities. You see how it is worked out. From current assets we minus current liabilities and is affected by various internal and external factors. Efficient working capital management balances the need for liquidity and profitability. Shortages can lead to insolvency, while excess can, you see, reduce overall returns. You should have sufficient working capital in the business. If you won't have, you see, sufficient working capital, you will not be in a position to do, you see, production. By using tools like ratio analysis and cash, you see, flow control methods, financial managers can optimize, you see, working capital levels. A clear understanding of the operating cycle, cash balance requirements and inventory or receivables management is critical for, you see, business success. So, working capital, how we work out, you see, from current assets we minus, you see, current liabilities. Working requirement of working capital is for buying raw material, for making payment to labor, for paying factory rent, electricity bill, other charges, you see, freight inward, freight outward. So we start with cash, then we buy raw material, then we convert raw material into semi-finished goods, then we make finished goods, and then we, you see, sell the products, and after sell, cash is realized. Payments, we receive payments. So we are starting with cash, in the end we are getting, you see, cash. This is one, you see, business cycle. So for this business cycle, company should have, you see, money, so that, you see, production, you see, does not suffer, and continuous production, you see, takes place. So now this was about working capital, and you see, we will do a quick revision. You see, now in this particular chapter we have studied, you see, how to manage, you see, cash flows, which are the sources from where we will, you see, receive the cash. We can receive money by issuing of, you see, shares, then preference shares, then our debts, you see, we have sold the goods on credit, you see, when our debts are realized we receive, you see, money. So now in a bank branch, you see, they do asset liability management, ALM. How they do it, you see, it is people's money. Bank accepts deposits, and then bank uses that money for, you see, giving loans. At any point of time, if a depositor comes to the bank for withdrawing money, bank should have sufficient money. Bank should return to his, you see, deposits on the due date. So they are managing the assets and liabilities. They are managing in such a way that, you see, every time bank is in a position to give back money to the depositors. At the same time, bank is following up with the loan customers. You see, bank is recovering this EMIs. You see, every month bank is asking customers to pay EMIs. Bank is asking customers to service the interest, so that liquidity is maintained in the, you see, bank. We are closing this session. Thank you very much, students.